Okay, what's going on, everyone? This is going to be the first video for chapter 4. What are we looking at here? Right, well, individual income tax overview. So we'll talk high level about the 1040. So that'll be kind of the first lecture here. And then afterwards, we'll talk about dependents and filing status. Right, so we kind of have a little running joke here: debit baby, credit cash, credit sleep, credit free time. Right, this is a journal entry when you have a baby. From the financial accounting side, from the tax side, right, we're going to learn about the difference between a deduction and a credit. Right, so one of the big things with having a kid is you could qualify for the child tax credit. Okay, and in this chapter, right, that's exactly what we're going to look at, right? The overview of the 1040, right? What's a deduction? What's a credit? Where does it kind of go on the forms? We'll talk about the difference between realization and recognition. They sound the same, but they mean different things. Deferrals and exclusions, we'll talk about. Deductions, specifically above the line and below the line. The calculation of the tax kind of formula and framework there. Credits, very high level overview on those. So this will be kind of the first lecture here. And again, we're going to look at this high level. When we look at, for example, income, deductions, credits, don't worry, we will have separate chapters on each of these kind of line items. So right now it's just getting the fundamentals, the blocking and the tackling down. So that'll be lecture 1. Afterwards in lecture 2, we'll look at dependents, right? What is a qualifying child? What is a qualifying relative? Why do you care about that, right? Well, for certain filing statuses, you need to have a dependent. In order to take the child tax credit, you need to have and claim them as a dependent, okay? And then we'll talk about filing status, right? The 5 different types of filing statuses. So at a very basic kind of baby level, right? If we like try to start as like small as possible, right? Little kind of baby Mario here, right? If we were looking at the tax formula, right, it's going to be your income minus your deductions, gets you your taxable income. You multiply it times the tax rate, which gets you what you owe. You back out anything you put into the system throughout the year, your prepayments, as well as you're going to subtract credits. And then either you'll owe money or you'll get a refund, right? So that's kind of the baby level, just fundamental there. Now we're going to give Mario the mushroom, right? He gets bigger, he becomes Super Mario. Those deductions, right? We're going to break those out between kind of above the line up here and then below the line down here, where the line in question is this AGI, right? So you start with your gross income, gross, like total, the full shooting match. You make adjustments to that, namely your above the line deductions, and that gets you your adjusted gross income, right? So you go from gross, you make adjustments, that gets you to your adjusted gross. You then back out below the line deductions, which we'll talk about. That gets you your taxable income. You multiply it by the tax rates, right? You go to little tables, you play Battleship. That gets you what you owe, as your kind of regular income tax liability. To that, you will add other taxes, right? So they're going to kind of like slide in here other taxes, things like self-employment tax, kitty tax. We'll talk about what those are when they come into play. That gives you what you owe in full, right? Your total taxes. You then back out credits, which reduce your tax liability dollar for dollar. You back out any prepayments, right? Did I, for example, from my employer withhold income tax throughout the year, right? That would be a prepayment. And then you'll either get taxes due or a refund, okay? So here is how this kind of manifests on the 1040. You can look at that. You can pull up a PDF of the 1040. Do not memorize tax forms for this class. Yes, we will see them when we do kind of VITA stuff. But if you're interested in, seeing more forms and doing more kind of compliance, we'll do a little bit, but that's really what that VITA clinic is for. And in this framework, right, kind of the starting point or one of the things we have to be aware of is there is a difference between realization and recognition, right? As a general rule, right, whatever you realize, you are going to recognize, right? So if you make $100 at your job, right, like, so there's kind of Kirby, all the income or items are going in there. Hey, maybe the link goes in there, right? He will then recognize, right, put on the tax return $100, right? That's going to be the general rule that realization equals recognition. However, right, we can have a couple exceptions to this, right? The first exception is going to be any exclusions, right? So let's change this and say you have $100 of muni bond interest income, right? In that situation, right, Kirby's going to kind of puff it back out, right? We are going to exclude all $100 and therefore we will recognize $0. So it's kind of the first exception. Then the second exception is going to be deferrals, right? This is kind of like later, right? It's like my little nephew Connor when trying to get him to read a book. I'm like, hey Connor, do you want to read right now? And he's like, later, right? That's just like a nice way of saying no. Here, right, we're going to basically say something like, look, we have the realization now, right? So maybe there is $100 now that we realized. We then essentially are going to kick the can on it, right? So right now we will recognize 0, right? We will defer 100, and then maybe next year, for example, in year 2 or year 3, then we will recognize it. So it's kind of a temporary deferral on it. So we'll look at each of those again, but for kind of the starting point, right, the first item is going to be gross income, right? If we look at that big kind of Super Mario layout there, we'll have a whole chapter on what gross income means, but essentially it's all income from whatever source derived, worldwide income. You make it here in the US, they're going to tax it. You make it over in Europe, they're going to tax it. When Elon Musk sends us to Mars, they're going to tax it, right? And essentially here, right, the first thing we'll have is our realized income. It's essentially what happened, right? When there's a change in property rights, we didn't have money before. We worked at our job, now we have money, right? So we have realization $100 from our job. And as a general rule, right, we will recognize that, i.e. put on the tax return. So to keep it straight in your head, realization is what happened. Recognition says, in light of what happened, how much are we actually going to put on the return? The more important of the two, honestly, is recognition, right? Because if you recognize it, then you're going to have to pay tax on it, okay? So that's going to be the general rule that we talked about, but we did say there's exceptions, right? The first would be exclusions, right? We are going to permanently exclude the income, right? It's like the Sandlot, if you've ever seen that, forever. We are forever and always going to exclude this income on the federal income tax return. So muni bond interest income, right? We will have realized, for example, $1,000, but we will recognize 0. That is to say, we will fully exclude all of that amount. And then deferrals, right, which we talked about, right, this is kind of like the Terminator, I'll be back, right? We're not necessarily going to claim it this year, but don't worry, it will be back. We're kicking the can on it. We will recognize it in a later year, right? So say, for example, we have $1,000 gain from an installment sale, right? However, you would recognize, right, maybe 100 of that we would do in year 1. So you don't have to defer the entire thing. You can defer part of it. But like in this example, we're just going to have 1,000 that we realize. 100 of that we'll recognize in year 1, 300 in year 2, 300 in year 3, and 300 in year 4, right? This is kind of the later, I'll be back, right? Yes, it happened in year 1, the realization, but it came back in subsequent years where we do recognize it. So here's some examples, right? These are some exclusions. We'll talk about those in the income chapter. Here are some deferrals. Right now, just kind of get the basics down, right? Don't try to memorize all these. We will look at them in subsequent chapters. If you're just picking up on, hey, we exclude this forever and we defer it temporarily, we kick the can, that's good enough for right now. Now, when that income comes in, right, we have now recognized it, you have to be aware that there are different characters of income, right? In other words, not all income is taxed the same way, right? Generally, most of the time, it's going to be ordinary income, right? What I mean by that is it's like earned income, wage income, and this could be taxed up to something like 37%, right? That's like the highest marginal tax rate. In distinction to that, however, we do have preferential income, right? So capital gain income. What does this mean? For right now, all you need to know is, hey, I buy a stock. Let's say I buy a stock for $1,000, right? 10 years later, I sell it for $10,000, right? So my amount realized or my selling price is 10, my basis or what I paid for that is 1,000. Hey, I have a $9,000 gain. If I held that stock for essentially more than 1 year, 366 days, that would be taxed at a preferential rate, 0, 15, or 20%, right? So that's if you hold it for more than a year. If I buy this on day one and then it is a crazy stock market and I sell it 5 days later, then it would be taxed at kind of normal tax rates, 37%. So you got to keep straight in your mind with these capital gains or losses. It's from a capital asset. It's basically, for right now, just think of it like a stock, but it could be any kind of personal use asset. We'll talk more about that. But that's one way where you can get preferential treatment, long-term capital gains. Another is qualified dividend income. You invest in a kind of domestic U.S. corporation, you meet certain holding requirement period, they pay you a dividend. That dividend will be taxed at 0, 15, or 20%. These things are important to know just at kind of a high level, right? Because if you're making investment decisions or you're looking at income, right, obviously you're going to prefer the preferential income, right? Because would you rather pay 37% or 0, 15, or 20? And how do they determine 0, 15, or 20? It's a function of how much other income you have, right? If you're a really high income earner, it might be 20%. If you're a low income earner, it might be 0%. One of the things to kind of keep these straight in your head and link it back to chapter 1, I've seen political ads on TV before, and not to get into politics, but just to kind of help with your critical thinking skills. But it was something like a teacher on there. Let's just say the teacher made 75 grand a year, and she was like, my tax rate is higher than this political candidate's tax rate on their income. So maybe the teacher, he or she was in like the 20% tax bracket, and the politician, maybe this really rich politician, their average tax rate or their effective tax rate might have been 15%. What they're really getting at there is, hey, I'm a teacher, I have earned income, I'm going to be this ordinary income. Whereas you, that kind of rich politician, all of your income is preferential income. So just things to keep straight in your head. It's always interesting, those kind of political ads, for what they say versus what it means. On the flip side, right, just to kind of keep a balanced conversation, it's something like 10%, the top 10% of earners pay 80% of all the taxes that are paid. So it's like, well, yes, do you have, probably a higher average or effective tax rate for the average Joe versus like a really rich person with all capital gains? Yes, but the really rich person probably from a gross amount pays more taxes. So that's kind of a balanced approach at it. It's up to you to decide what you think is right or fair there, but I'm trying to connect this back to chapter 1. Okay, so we have our income, right? We figured out, what kind of funnels through there with Kirby. So we have our gross income. First thing we're going to do is make some adjustments to that, right? So we'll have our above the line deductions, which will get us to our AGI. Then we'll take our below the line deductions. We have a whole chapter on deductions, right? And essentially with a deduction, right, this is kind of like the income. It's coming towards us. It's coming towards us. Deductions are our weapons that help reduce the income, right? So deductions are a good thing, right? The more deduction you have, the less taxable income you have. The less taxable income you have, the less tax you pay. The less tax you pay, the more money you keep. Ergo, deductions are a good thing. So we start with the above the line deductions. And essentially these are a series of deductions like A, B, C, D, E, F, if you qualify for them, right? Oh, hey, I qualify for that one, I qualify for that one, you get it, right? What would be kind of a simple example of a deduction? Hey, I made a traditional IRA contribution. I, fall within the kind of phase out thresholds. Everything's good. Hey, I get an above the line deduction for that. And again, we'll talk about each of these. With regard to below the line deductions, there's really kind of three of them that you have to be aware of. 1, 2, and 3, right? Don't mix these all up, right? Keep it straight in your head. The first one, right, is kind of a fork in the road, right? You have to, like Indiana Jones, choose wisely, right? We need to compare the standard deduction, a flat amount everybody gets, right? And don't memorize the standard deduction for the exam. Let's just say if you're single, it's roughly $16,000 versus itemized deductions, right? If you're going to itemize. And itemized, again, is kind of a series of deductions, 1, 2, 3, 4, 5, 6. And whatever ones you qualify for, hey, I qualify for this, I qualify for this, qualify for that. So this is like 3, 5, and 5, right? Add them all up, right? I'm at 13. So you have to compare these two. And as a general rule, you're going to want to pick the bigger, right? So in this case, the standard deduction would be bigger. It's totally possible your itemized deductions could be bigger. You always have to compare. And again, we'll talk about what the itemized deductions are. So that's kind of the first one that you do there. The second below the line deduction is the QBI deduction. This is something like, and it's always changing because it's inflation adjusted now, you can just think of 20% of flow through income. What do I mean by this? Right, so when there was tax reform 1.0, the TCJA, like 2016, 2017 with Trump, what they had at that point in time was C Corps, the highest marginal tax rate on that for them was 35%. They permanently took that down to 21%, right? So from 35 to 21. Well, again, kind of talking about my niece and nephew here. If I give my nephew a cookie, you can bet my niece is going to be right there and going to be like, where's my cookie? So essentially all the owners of the flow-through entities, right, the partners in a partnership, the shareholders in the S Corp, the self-employed individuals, they were like, look, you did this stuff for the C Corps, where's our cookie, right? This is the idea of this cookie, right? QBI, qualified business income. If you have the right type of income, typically flow-through income or self-employment income, you can qualify for this. So, hey, I'm a partner in a partnership. I get a K1. That K1 says I have 100 grand of income from the partnership. I would get a deduction theoretically for $20,000. It's not that simple in real life, but just keeping the things in your head straight for right now, that's the way you can think of it. The next one are the Big Beautiful Bill Act deductions. These are new, and again, we'll talk about them, but these are kind of like the above the line deductions. There's 4 of them. If you qualify for them, you get it on there. Okay, so it's like the tip deduction, the overtime deduction, qualified car loan interest deduction, and the senior deduction. Again, we'll look at the specifics of each of these in later chapters. Here's the standard deduction. Again, don't memorize this, but maybe if you're doing the homework or something like that, here's where you can find those numbers. Right, when we talk about it, right, we said you have your gross income, you do your above the line deductions or those adjustments, and that gets you your adjusted gross income. This is kind of an important benchmark, right? They use this a lot in the tax code as well as in the real world. So in order for you to qualify for certain tax credits and deductions with phase outs and phase ins, they'll say, well, we need to look at what your AGI is, right? Likewise, it's connected to your student loans. If you're on a income-based repayment plan, right? It might be something like, look, you pay 5 or 10% of your AGI throughout the year on your student loans. It tells you whether you can contribute to potentially an IRA. They look at your AGI. Do you qualify for FAFSA, scholarships, grants? You want to buy a home, right? They'll probably want to see your tax return. So this is kind of a good benchmark. Another area you'll see it is when you go to e-file, right? Say you're kind of doing the 2025 tax return, they'll say something like, in order for you to e-file, can you please enter in your 2024 last year's AGI number? And then you have to kind of pull up last year's tax return. To do that, that's like kind of a safeguard to make sure there isn't fraud. But do be aware, AGI is an important number. There's also something called MAGI, which is essentially your AGI that's modified, right? So they'll say for this credit or this deduction, your MAGI has to be this. And they basically take that AGI, they add or subtract things to it based off what the specific criteria is for that deduction or credit. But just be aware, like AGI is the starting point. Sometimes they use this like MAGI term, which is your AGI, where we make adjustments. You have your AGI, right? Then you have to pick generally the bigger of the standard deduction or your itemized deduction. So let's say the standard deduction is 16, your itemized deductions 2, 4, 1, right? So you're at 7 over here. Hey, we have the winner on the left side. It could be the reverse, right? Say your standard deduction is 16. This is 10, 5, 2, 1, 1, right? So we're at 2, 4, 5, 10. We're at 19 over here, right? This would be the winner. Okay. Let's talk a little bit more here for this, right? So we have our gross income less our deductions gets us our taxable income. Then we kind of go play Battleship, right? We look at those tax tables, we figure out our regular tax liability. Then, right, so maybe our regular tax liability is, hey, you make 160 grand, then you will owe 15, right? We use the table, whatever that kind of framework is. Then you add to that other taxes, alternative minimum tax. This basically makes sure that rich people pay enough tax. Kiddie tax, this looks at that you're trying to not shift too much passive income to your kid. Net investment income tax, this is if you have too much passive income. And then self-employment tax, if you're self-employed, you have your own trade or business. Again, a whole chapter on these, but let's say our AMT was 2 and our self-employment tax was 2. Hey, there is our other taxes. We're looking at potentially $19,000 total, okay? We now know that we owe 19, right? That's kind of our all-in number, what we owe. The first thing we're going to subtract from that are tax credits, right? These reduce our tax liability dollar for dollar, right? So the way I like to think of it is like a credit is like a dollar-based coupon, whereas a deduction is kind of a percentage-based coupon. Generally, credits are going to be better than deductions, right? If it's the same amount, right? Like, would you rather have a $5 credit or a $5 deduction, right? All day, every day, you're going to want to take the credit because it directly reduces your tax liability, right? So if we just map it out, right? If I told you, for example, looking at this, a $50 deduction, right? If we have a deduction and it's $50, right? You reduce your income by $50, you'll save 10% there, that tax rate, the marginal tax rate. Hey, there's $5 in savings, right? Compare that with a credit for $50, right? It's going to be $50 in savings because it directly, right off the bat, reduces your tax liability, right? So the power of a deduction or how good it is basically a function of the amount of the deduction and the marginal tax rate. Generally, credits are going to be better, but there are situations, right, where they may not be, right? So let's just say there was $1 million deduction. I don't know, let's say the tax rate is 20%, right? So there would be 200,000, and compare that with, I don't know, a $50,000 credit, right? If I told you, would you rather have $1 million deduction or a $50,000 credit? Well, in this case, the deduction is going to win because when you do that apples to apples comparison with the savings, right, it does save you more. So you have to be able to look at that math and kind of compare it, Okay. After you back out your credits, right? So I don't know, let's just say we owe 19, we had 5 in credits, right? So now we're at 14. Then we back out any withholdings, estimated payments, and prior year overpayments. What do these mean? Right, your withholdings, right? So let's say you have your first job, right? You do $20 an hour and you work 10 hours, right? So you're like, this is great. My paycheck should be 200 bucks. You get your paycheck and you're like, oh, it's 160, right? Where did my money go, right? Well, the difference there, the 40 was taxes. In other words, your employer withheld that money, right? It's withheld on your behalf and they send it into the IRS, right? So that would be a prepayment on there. And that would be if you're an employee. In distinction, right, if you are an independent contractor, you're self-employed. Let's say, for example, you drive Uber, right? Uh, when you work for Uber, if you earn $200, right, they're going to give you the full $200 on the check, right? Then it's your responsibility quarterly to make estimated payments on there into the IRS. And then prior year overpayments, these are essentially, hey, maybe on last year's tax return, I was supposed to get a refund. And I say, hey, instead of giving me that refund now, can you please apply this to next year's tax liability? So it's kind of like a very early quarterly estimated payment. You just carry it over from the prior year. Okay, so if we're looking at it, right, we're at 14. Let's say during the year we withheld 16, right? Hey, we're going to be, in this case, $2 overpaid, right? So when we get a refund, it's just kind of getting our money back on there. If you compare that with, right, we owe 14 there, and then maybe we put 10 into the system, right? Then in that case, you didn't put enough in, and you're going to owe. What's kind of the best kind of setup here? Like, do you want to owe? Do you want to, get a refund? Well, theoretically, right, the best kind of thing is you should break even, right? You shouldn't get a refund. You shouldn't get, you shouldn't owe, right? And what are the reasons for this? Well, if you owe, they could hit you with interest and penalties on it, right? So you owe 4, and then maybe you owe $1,000 more in interest and penalties. So it's never good to owe. On the flip side, it's not really good to get a refund because this is essentially a return of capital, right? If we think about opportunity cost, you're really giving an interest-free loan to the government, right? You would have been better off just not putting as much into the system throughout the year, investing that money, and then you could have made money on that refund, right? So you would need to adjust those withholdings from your employer on that W-4 form. Okay, so let's look at a couple quick examples and then we'll wrap this up. So we got 4-1 here. They have a husband and wife. Looks like they have some salary there. They also have corporate bond interest and muni bond interest. What's their gross income? Well, it's going to essentially be all of those items, right? Corporate bond interest is taxable, but muni bond interest is excluded. So it's not all bond interest, right? It's only muni bond interest. The character there, you can look at that. They talk about when they sell a stock at a gain. Hey, if you held it for more than a year, it'll be a long-term gain. It could also be a loss. We'll talk about how you could use that loss potentially to offset ordinary income up to a certain amount. In any event, right, they have their gross income of 156. Their only above the line deduction is 5. So their AGI is 145,000. Okay, so we went from our gross, make our above the line, we get to our AGI. Once we then have that AGI, right, we need to compare as kind of the first item, the bigger of that fork in the road, the standard deduction or our itemized deductions, right? Here's a situation where the standard deduction would be bigger. Hey, here's a situation like down there where itemized would be bigger. In addition to that, you also get the QBI deduction. In addition to that, you also get the big beautiful bill deduction. So it's not like you pick the bigger of all of these, right? It's only the bigger of the standard deduction or itemized. And then if you qualify for QBI, you get it. If you qualify for the Big Beautiful Bill Act deductions, you get it. Okay. this is just showing you, how income is taxed. You can look at that there. Here's an idea of a credit, right? We owe 14,000. We back out our credits first. We then back out any withholdings, for example, from our paycheck. We must not have put enough into the system. So we're going to owe $30. But with this, we're at about the half-hour mark. I like to keep these around here because I'll lose you if we do much longer than this. We'll end it here. We'll see you in video 2.